till we groan.
Welcome.
Ciao a tutti. I apologize for my lack of Italian, but I will do my best. It's quite an interesting topic today, is high-yielding opportunities. From what point is it too good to be true? Which I think in the aftermath of Terra Luna is an interesting topic to talk about. So what do I know about yield? I spent 25 years in finance, 15 years managing about $14 billion across 44 strategies, all to do with yield enhancement, be it derivatives, be it lending, borrowing, etc. So moving into the sort of crypto or digital asset space has been quite interesting for me because a lot of the things that we see in DeFi and arbitrage strategies and other yield strategies have been done many times before, and here I am today, hopefully can walk you through what to look at. So there's actually many different ways to achieve yield, and I'm only going to go into sort of three of them. The first is liquidity provision, which is kind of what we see with automated market makers. The AMMs require liquidity to incentivize by providing financial rewards, or what I call bribes, in exchange for it. So there's what we call a risk-free rate, and then there's what's above that. There's lending and borrowing, which is just I loan you some coins or I loan you some assets and you pay me some kind of interest on that. And on top of that, we have kind of market-neutral strategies, which I think a lot of companies that provide yielding products use on top of DeFi and other strategies to enhance the yield they offer. So here we have arbitrage strategies such as basis trading, venue arbitrage, triangulation arbitrage, liquidation, integrated, and volatility arbitrage. And I'll go into that in some detail. So I don't know if this comes up quite interesting. It's probably quite a bad slide to show, but this is DeFi Llama, and it's a list of all the yields or the top yields you can get in stablecoins, and they range between about 1% and 4%. And there's a real outlier up there in a project called Anchor that's paying 18%. Don't know if any of you have heard of that. So if you think about it and you look at this slide and you say, hey, I've got 1%, 1.4%, 2%, 2.2%, 2.3%, 2.3%, 1.4%, 18%, 1.3%, 1.3%, there's a real outlier there. And obviously there's a reason why there's an outlier there. And so the way we look at kind of intrinsic value of DeFi flows come from two core operations, right? The first is fees from liquidity provision, and the second is interest rates on lending. And the value above this level is generally speculative in nature. So if you're seeing yields above what I would say the standard rates of around 2 to 3%, then we start to enter into kind of a speculative area of finance. So if I look at this number of wallets created on Terra Station, we've gone from none to 4.12 million wallets. And starting from June 2021, the Terra ecosystem experienced an unprecedented increase in total value locked that jumped from $500 million to $18 billion at its peak in mid-May. So obviously a lot of people saw that yield and saw that opportunity, and obviously we can see here from the numbers that they went into it. So they did some research, and there's a great paper on Terra Money by a Harvard professor called Marco DiMaggio and someone associated with a project called Nicholas Palacios. And it says, Terra achieves price stability by creating stable incentives for mining on a proof-of-stake consensus. And our findings, based on 1 million years worth of simulated data, indicate that Terra's peg is highly robust under both forms of stress. How good is your maths? Because one of the things that I find really interesting about this slide and this paper that was written is many people relied on this research paper to justify how stable and how safe this ecosystem was. About 30 years ago, there was another paper written by Joe Stiglitz, who's a Nobel Prize-winning economist at Columbia University, and they wrote a paper on Fannie Mae and Freddie Mac, which was, it is impossible that they will go bust. And we obviously know that that didn't happen. So this paper belongs in a museum because its flawed mathematics really are on show because they've used a Monte Carlo analysis to do this. But what we learned in the days of LTCM, which was a big hedge fund back in the 90s, was unless we model the tail risk properly, modeling these kind of things with geometric Brownian motion give you absurd results. And as we saw in May, obviously it didn't take a million years for this thing to fall apart. And it's really interesting that we rely on quite complex research papers to justify why this thing looks quite stable or why this can't go wrong. And obviously it did. And I'm sure that if you want to go to the Harvard Business School and see this paper, it's available, you can read it, and if your maths is strong, you'll understand where things actually go wrong. But that's what happened, and we all know what happened. And statistically, that was impossible, but obviously it did happen. And this is why I'm here to talk today, is how good, is it too good to be true? So the first thing I would say is, don't put your money in boxes you don't understand. And most, not all boxes are short credit default swap contracts. And if you understand this, then you understand the risk of default, which is the rug pull in crypto speak. So there's some real-time metrics to consider when looking at a pool's risk-reward opportunity. And the first one is the ratio of circulating market caps of the respective coins, the flows in and out of the pool, liquidity reserves in curve, burn rates of APY generating reserves, as you saw with Luna, it got quite scary. Behavior of the large holders. Now, if you see what the large holders are doing, then you probably want to be very careful of that. And order book dynamics, like how deep is the order book? Like how much liquidity is there really there? And if you can't find where the yield is coming from, then effectively it's coming from future bag holders, as in you are the yield. If you don't know where it's coming from, it's you. And sustainability factors that need to be assessed are who are the founders and what is their track record? What is the economic loop? Like how does the money come in? How does it get paid out? Do the fees generate to justify the yield being paid? What kind of runway exists to build long-term value and sustainability to the protocol? And can the reward token achieve a long-term value proposition and therefore potential upside to the yields? And this is where the quality of the project becomes really, really important. I mean, there's lots of people here probably working on projects at the moment. They've got great ideas, great build-out, great infrastructure. But do you have the runway to actually get the thing finished? At what point does it become, we just can't sustain this? And as things get bigger, the market becomes much more unstable. And the reason why it becomes unstable is if you've got $20 million of coins, it's not interesting from a trader's perspective or an arbitrager's perspective, if from an institutional scale, to go after a $20 million coin or a $20 million token. Get to 100 million, you start to get some sort of more smarter traders come into the market because there's quite a lot of opportunity there. When you get to billions, you get the likes of Citadel, Jump Trading, others that come in and say, hey, we can play this. And the payoff is obscene, and it makes it worthwhile. So the question is can you defend the economics of your token in the face of huge amounts of capital that will challenge the thinking behind it? And as we saw with Terra Luna, that the money that went into that to essentially take it apart was unprecedented. So the other way we look at yield, and I think it's quite important, is arbitrage. And I want to go into this because as we've seen yields collapse over the last year, and I'll show you this on a slide coming up, we start to look at alternative ways to achieve yields. And what's really interesting in arbitrage is that we still have quite a nascent market. There's still huge amounts of arbitrage opportunities that we deal with on a daily basis. And the reasons for this are extreme volatility and high momentum with temporary dislocations and lower liquidity creates these opportunities. Crypto is generally a retail-driven and sentiment-driven market, which makes providing liquidity and sentiment trading exploitable. And I'll show you what I mean by that in a second. The derivatives market is still very, very young, and it's quite diversified. And if any of you are trading options, you'll notice that the way the vol surface of crypto derivatives works is kind of mispriced. And it's mispriced because it's so illiquid. And it's very, very hard to monetize options in crypto if you're buying the wings. By the wings, I mean like the higher strikes. It's given the vol that you have to pay for it, or the volatility price that you have to pay for it. A lack of credit lines. Now, we have some prime brokerages out there that work and provide credit lines cross-exchange, but because there is a lack of credit throughout the crypto market, opportunities to exploit different venues, different coin pricings, etc., are there all the time. And we see lots of managers and lots of traders go after these different opportunities. And then we look at the volatility, there's momentum, there's temporary drawdowns, there's huge leverage in the system. And all of these things and the correlation between coins contribute to an increase in what we call alpha-generating strategies. So if we take these three things, which is liquidity provision for market makers, lending and borrowing, paying about 1% to 2%, maybe 3 or 4%, and we see yields offered around 9, 10%, 12%, 15%, 20%, 40%, 50%. How do you find out where those yields are coming from? At what point do you think, hey, this is not possible? And if all you're doing is providing liquidity to market makers, someone paying you 10%, I'm not sure that that's a risk-free opportunity. If you're lending coins out and you're lending the main coins out and someone's paying you 10%, once again, I think that's not a sustainable model. But if they're paying 10% and they're using a combination of strategies, then it is possible that you can get quite high yields. And so if we look at the different arbitrage types in the marketplace, you can see that we have cross-exchange, where you buy Bitcoin on one exchange, sell it on another exchange. That's increasingly hard to monetize. We have the triangular arbitrage. Now, what's a triangular arbitrage? Well, I buy dollar Bitcoin, I sell dollar ETH, and I sell BTC ETH on another exchange. So essentially, I take the BTC, I take the ETH, and I take the BTC ETH cross, and I monetize that. And if I'm on 3 different exchanges, I need 3 different accounts. I need collateral on all those accounts. I need to be able to trade there. So having a prime broker that can provide credit across those exchanges gives you greater efficiency. So there are managers that have much greater efficiency to exploit these opportunities than others that just don't have the setup to do it. Basis arbitrage is essentially futures or perpetual swaps versus spot. That's just kind of extracting the yield or the interest that it costs to borrow. As we see lots of momentum in the market, we see these basis spreads move out quite a lot, and there's a lot of opportunity to be had there. Liquidation. If you're fully levered and we start to see markets collapse, we start to see a real opportunity to monetize kind of the liquidation that happens on exchanges. And people that run these kind of strategies, they do very well, but the liquidation doesn't happen very often. So it's not something that you can go out and do straight away and say, hey, we just run liquidation strategies. They're kind of event risk strategies. Integrated is when we start to see structured products, we can break them down, we can back out different components, and we can generate yield from that. And options arbitrage is really just looking at the options market, looking at the spot market, looking at the volatility the being sold and where you and bought, and seeing if there's an opportunity to replicate options without taking any market risk. And so when we talk about arbitrage, we talk about market neutral strategies. And to give you an idea of the kind of returns you can get in arbitrage over the last three and a half years, you can see from this slide that we've got roughly 20% in 2019, roughly 18% in 2020, 36% in 2021. And you can see that at the start of the year, we sort of huge opportunity of making 6%, nearly 5%, 3%, nearly 7%. And this is when all the leverage started to come into the market, and we saw that massive rally in crypto assets all the way through to October of the year. But as that market started to get really, really stretched and people were borrowing a lot more, and we see this sort of the market become available, we can see huge opportunities in this kind of basis arbitrage that took place in the early part of 2021. And as you get more towards the end of the year, it starts to tail off. And then we get to this year. Now, where is what I call risk-free rates in arbitrage? We're around 1% a month at the moment. So these are a combination of what I would say the best arbitrage traders in the world, trading hundreds of millions of dollars of capital on their books and probably billions of dollars of turnover a month. And you can see here that if someone's saying to you, hey, you can get 10% with us or 12% with us, and they're running these kind of strategies on top of DeFi strategies, on top of lending strategies, those yields aren't necessarily impossible to achieve. In fact, they're quite easy to achieve sometimes. But if they're not running these kind of strategies on the side of what they're doing, I do sometimes feel that the incentives to provide liquidity to a pool becomes a lot harder. So if you take the sort of portfolios that we run at Yield App, this is the sort of stuff we do on top of the DeFi, on top of lending. We don't lend out capital, but when we borrow money, when we borrow client capital, we start to deploy it in different strategies to kind of achieve the yields we have. And the great thing about the arbitrage strategies this month, given the Terra Luna situation, is that they're all up. They've all done very well, because essentially they're not taking any risk. So as we see lots of volatility in the marketplace, we see lots of arbitrage opportunities exist. And as we move through different cycles of the Bitcoin ecosystem or the crypto ecosystem, these opportunities come and go. As you see now, we've collapsed that at 2022 versus 2021. So what we would say now is that the risk-free rate in pure DeFi is about 3 to 4% on stablecoins. We would say it's about 2 to 3% in lending, and we say it's about 8% to 9% in arbitrage strategies as we currently stand. And so where you see these yields that are being sort of paid higher than this, the incentives are there to sort of give the project or give the business the traction it needs to get to where it needs to get to. And if it doesn't get there, then that credit default swap that you're short essentially becomes worth a lot less than you paid for it. So that's my 20 minutes of yield strategies that you can look at. And ultimately, what I would say to you is when you're looking at sort of DeFi yields and you're looking at opportunities out there to get a return on your crypto assets, really try and understand where those yields are coming from. If you can find yields in DeFi that are paying 10, 15% based on AMM or lending and borrowing, try and understand how that's being achieved. If you see yields that are being paid on platforms that are multi-strategy, doing arbitrage, doing DeFi, doing borrowing and lending, etc., then those probably are a lot more sustainable. Thank you very much.
Blockchain Week Rome.